Hey everyone, I want to talk a little bit about volatility and the potential for volatility in the equity market, specifically to pick up here as we head into parts of July. Maybe it's more August-ish period, but just want to give you some perspective on that. First of all, I know there's some seasonality out there that certainly talks about the August through October period to be more volatile. I want to show you guys a couple of other ways of looking at this right now, of how we could make an argument that maybe we will start to see volatility, some return of volatility, maybe a little bit earlier. It's not really our base case, but I want you guys to see a couple things that I think is going to help you and go a long way. So what we are going to look at first of all is this very simple chart, which has two simple lines. On the top, you have the S&P 500, and at the bottom, you have something called average true range. It's usually the short sort of name for it is ATR. Maybe you've heard of that before. And basically what this 14-day average ATR is a 14-day measure. Basically what it's showing us is the average daily movement of the S&P 500 over the past 14 days. And it's a little bit like, in fact, it's very much like looking at the VIX, except that the VIX prices is options pricing, so it includes implied volatility in the pricing, whereas this is the actual price movement of the S&P 500. This is what they call historical volatility, I guess is another way of putting at it. It's very similar to that. And you can say that volatility is getting very low. Now, what's most interesting about this, and we've talked about this and we've been making a big deal to clients about this for the past month and a half or so, is that if you zoom in I'm going to zoom in a bit closer. Not only has let's start here. Not only has the average true range certainly and obviously continued to deteriorate since March of 2020, which was the bottom of the pandemic lows in equities, but I want to get a bit more closer because there's an important point of how we might be able to measure and sort of extract and evaluate what might happen going forward. So let me zoom in a bit closer, and specifically what I want to focus on is the period in both price movement on the S&P on top and at the bottom as reflected with the average true range since early March. What happened in early March, and maybe you're not aware of this, but what happened in early March is when a lot of the real alpha trade or even the beta trade where everything just rose together, reopening stocks, technology and other things really started peaking out so far for the year. I think they could go higher again, but that's where they stalled. So the real rally actually started to stall out in March, even though you wouldn't know it by looking at the S&P, which has continued to make all-time highs. That's largely due to the rotation within the market, but equally, maybe more importantly, so due to the very heavily the strong weighing of big few stocks, mega cap stocks like Apple and so on and so forth, which have acted well for the past few weeks. So my way of looking at this right now is that if we are now at a fairly low point in average in volatility, and as expressed by the average true range, and the peak in March in ATR for year to date so far was where the broader market, the sort of momentum trade topped. I would suspect that even if we were to see a spike in volatility, it may be more related to some of the names that have been more or less treading water or even outright going down quite a bit for the past couple of months, that they may start coming alive again. Now, we certainly have one thing that is the bigger problem that we have to contend with, or not the bigger problem, just the bigger fact, and that is, and I'm going to get rid of this, is interest rates. And I am just going to bring up the 10-year yield of the U.S. Treasury note. That's the real word for it. And this is just a simple candlestick chart, but there is a huge debate, and that's largely what's also kept the market more or less going sideways. If you look, by the way, if you look at early March, remember that period I just talked about? In this case, it's mid-March. Remember when ATR topped, I just showed you in the S&P 500? Well, guess what bond yields did in mid-March? They topped for until at least so far year to date. So it's all the same trade. So I would think that if we were to see yields start to go higher, or the average true range start to go higher, more movement in equities, doesn't have to be a crash in the market. It can be a move to the upside indeed. We could start to see that being a part of interest rates starting to go higher again. So we're in a bit of a wait and see mode right here. We've been for the past month and a half or so. I think it'll become very clear when this next trade starts to work out. And again, you want to watch the ATR very closely because it is very closely correlated to what's happening in 10-year yields. That's kind of the punchline here. So we will keep you updated on this, but this is really, really important, in my opinion, the most important thing to watch right now if you're an equity investor, if you're a fixed income investor on the rate side, and just for broader economic, for the broader, sort of economic backdrop, because again, yields are ultimately where that are going to indicate where things are going. So I hope this is helpful, and we will see you in the next video.